Ladies and gentlemen, thanks very much for joining us for Renaissance Capital's Central Europe conference, which is happening over 2 days. You've got about half a century's worth of experience between me and Dan when we're looking at Central Europe. I think we've both spent more time across the region than we can possibly count. And so hopefully we're going to give you a little bit of the value from that experience in some short presentations just to outline the macro outlook, but also the equity strategy outlook from Dan. And if you can then hang around or come back in for the session, the macro session, we've got the Prime Minister of Romania, the former Finance Minister of Poland, and also the Czech Central Bank, trying to discuss where we're going to be going in Central Europe for the next 10 years. If I can jump in with this presentation first. Big picture, obviously I'm just worried about US Treasuries. This is my base case, as you'll have probably heard over the last year or so, is that US Treasury yields are unlikely to rise above 2% for the next 10 years. I'm assuming that Germany, which is the red line on this chart, will be tracking Japan with the 17-year lag, and that's already been happening for 12, 13 years. And we're thinking the US is anchored by those low German Bund yields and can't go much above 2. That is looking like a shakier assumption right now. We've obviously got the huge stimulus and the markets are pushing up the US 10-year. And that's got some implications on the currency for a start. Euro dollar, last year, the point we were trying to get across was that the change of US president was a shift away from protectionism. That protectionism had encouraged the orange bar, the orange column, which is American investment into America, foreign direct investors going into the States, to be putting hundreds of billions of dollars into America. But the blue column, which was American investment abroad, had collapsed. In fact, technically it went negative in 2018, thanks to the tax rebate plan that Trump pushed through. And the consequence of that is the gray line, which is what was net FDI doing. And for a long time in the 2000s, when Central Europe was booming, but also up to about 2014, we had a net FDI leaving America, going to the rest of the world. But in the last 4 or 5 years, it was going to America. And I think that was supporting the dollar. What we've got now is a battle between portfolio investment trends, which might actually favor the US because US yields are looking pretty attractive relative to Eurozone. The stimulus plan is quite supportive of US equities. But I don't think we've probably got net FDI going to America anymore. But I also don't think it's leaving in a big way either. So I think from 2022, that's more likely to happen. We're going to see US investors starting to put factories offshore. But for now, if anything, potentially the dollar strength we're seeing at the moment is connected to this rising US Treasury yield story. But from next year onwards, I'm imagining FDI helps push the euro 2-3% stronger a year. And if it's going to do that, then euro proxies like Central Europe and all of these currencies are euro proxies start to look interesting. In terms of our real effective exchange rate model on the currencies, there's not a great deal to say about them, to be honest. The middle column there is what the currency rate today is versus its long-term average. I'm putting in Portugal and Greece as references, but Poland is within 2, been massive in Central Europe over the last 25 years, and Czechia perhaps more than most. 25 years ago, Skoda cars were a laughing stock, and now, well, I nearly bought one about 10 years ago. I don't know if that's a good thing or not, but still, the point is the quality's gone up a great deal. And long term, I think the Czech currency is a little like the Swiss franc or the Japanese yen or Chinese currency, one that's likely to appreciate over the long run. And so my bias is that that's what we'll see in Central Europe. They're moving up the value-added curve. They're converging towards developed market status. Currency strength is more likely than not. The interesting story, and we've been talking about it since 2014 is shrinking workforces. The reason COVID's such a shocker right now, leaving aside the number of cases, is that the populations are getting older in Central Europe. And that aging population we're seeing then in shrinking workforces. Czech Republic, the surprise when I looked at the figures here is that the Czech Republic has actually had the worst of it. The biggest shrinkage of the working age population was 2015 to 20, when it dropped by 4% over 5 years. It's only going to drop 2% in the next 5 and barely drop at all by the late 2020s. Hungary's also getting better. Romania's also getting better. So this issue we've been talking about for a while is oddly, well, it's still worsening, but it's not, we've turned the worst of it, except in Poland. So Poland's actually got the biggest shrinkage, and you'll have all heard about the 1 million Ukrainians, or maybe 2 million Ukrainians, who came to work in Poland as a result of these labour shortages already. Labour shortages have obviously helped keep unemployment very low. These are the latest numbers, mostly from January, February, and Central Europe's looking great from that perspective. We've also got massive rises of employment. So you go back 10, 15 years, and it was quite common to retire quite young in Central Europe. That's become less common. You've had Orban in Hungary over the last 10 years say, we're going to cut government spending on benefits, and we are going to give you tax cuts, which would encourage you to move from not working to working. It's had a dramatic difference. Impact. You've gone from 60% employment ratio to 75%. So over the next 5 years, what can we imagine? We can imagine more of the Central Europeans heading up to that 80% level that the Czechs have achieved. The highest in the world is about 85%. So there is some more scope perhaps for more people to enter the labour market locally, but we're getting a bit towards the end game on that. The consequence then of this labour shrinkage and the rising employment is that as we struggle to find more people to employ in Central Europe, the wages have to go up, and they've already done that. So this is dollar wages, monthly figures from a month ago. It's about $600-700 in Central Europe now. The PIS a couple of years ago were promising that by 2023 in Poland, this figure would get to $1,000. Now that would be not that far off the United States, which is of course why Biden wants to get the minimum wage up to $15 an hour, which would push America to about $2,500, by the way. But we are likely to see continuing rise in wages. My big picture story on Central Europe is it's just getting back to where it should have been a long, long time ago. If you go back 100 years, adult literacy is an amazingly good leading indicator for wealth. 100 years later, it didn't work for Central Europe because of communism. But in the last 30 years, the adult literacy rates of nearly 100% in Central Europe is now getting reflected in per capita GDP. So if you go back to 1995, Poland was what, 30% of Greece or Portuguese per capita GDP. It's now back to 84%. Czech has already surpassed them. And I think Hungary and Poland will be following. One thing I found a little bit odd in the forecast when I was writing up the report that I emailed out last week was that this consensus view that Central Europe just grows at about 1 to 2% above the Eurozone is a little unlikely. You can see the volatility we've had in growth over the last 25 years. The odds that it's that close and that ideally above Central Eurozone is improbable. If I had to take a guess as to which country will disappoint, well, the market seems to quite like Poland. And I wonder whether that's because it's the biggest economy. So if you're a Central European economist, you're going to big up your biggest market, right? I think the demographics are telling us that we might get some relative disappointment, maybe 3% growth rather than 4% on average for the next 5 years for the others. Interest rates, again, this is going to come back a little bit to potentially US Treasury story, where we go with the Eurozone. I mean, as it stands, people are not expecting much in the way of rate hikes. And while we're seeing them in Russia, or Turkey temporarily probably now, we're seeing them in Brazil, it's easier to imagine that Central Europe will be much more linked to what the ECB does. So I haven't got a big call to make on that. Banks, big deal for the equity market, and Dan will be talking about that in a minute. But it's been really disappointing from my perspective to see so little private sector credit growth over the last 10 years. We had the boom up to 2008 and then the bust, and it really does look like most in Central Europe haven't got excited again about rising loans. Why has that surprised me? Because as incomes have gone up, wages have gone up, we've seen that. And as companies are saying, I've got a shortage of labor, and labor's getting more expensive, you'd expect them to borrow, to automate, to have more robots, and you'd expect retail households to be borrowing more because they're richer, and they can. But it just hasn't come out in the data much. I mean, a little bit in Hungary over the last 2 years. Not only is private sector debt low, but also public sector debt is low. And again, compared to developed market norms, Central Europe's looking really good. We did have the PSD government of 2017, 18, 19 blow up the budget in Romania. But I think, and we'll hear more about this soon, the new government led by Florian Kicu is going to do a much better job getting that back under control. So, big picture, dollar euro is obviously going to play a big role in your thinking on this stuff. I would argue the currencies are likely to be where they are versus euro, or potentially a bit stronger over time, owing to these big productivity improvements. We should get better growth out of Central Europe for years to come. I mean, I think of them as a bit like the Korea and Taiwans of emerging markets, but for the EMEA time zone. So that's my section done. There is the report. There's lots of numbers in that if you need to see that. I'm now going to hand over to Dan Salter to go through the equity strategy aspect.
Thank you, Charlie, and hello, everyone. I've got a few equity-related slides for you today. Starting off with, firstly, what does Central Europe offer you as investors? And I hope the slides are going to show on your screen shortly. Well, I'll keep talking. I think the slides are now appearing. So firstly, what does Central Europe offer you as investors? Really, in my view, it's very steady economic convergence with the EU 14. That's the pre-expansion EU countries. Back in the mid-1990s, we thought that convergence might take around 50 years. It's actually going to take a little bit longer than that. We're now 25 years in, and we've gone from an average of 18% of EU 14 levels back then in 1995 to 43% for the countries on this graph. So we're talking about a percentage point per year of GDP convergence with those EU 14 countries. Now the leaders, Czechia and Slovenia, have overtaken Greece and Portugal already and are nudging up against Spain. But in general, it's fair to say there's plenty of economic convergence still to go, and it's proving pretty hard to knock countries off their convergence glide paths, as you can see in the graph here. But equity markets have not really rewarded this decent economic story. Only Romania has beaten the emerging market index at decade-long periods. And so the growth in Central Europe has been decent, but it's been less than those of other emerging markets. And so therefore, the equity returns have lagged the rest of EM over the last decade. The second issue is that Central Europe is quite small now. It's just 1% of the emerging market index. We did a sampling of global emerging market funds earlier, and we found that large global emerging market funds are now down to around 100 holdings. So that means for their 1% allocation to Central Europe, they might be looking for just one name in the region. As you can see from the left-hand graph here, the smaller the market, the fewer funds tend to be interested in it. So for even the largest market, Poland, more than half of global emerging market funds have zero exposure. The other issue is that the specialist EMEA dedicated funds, which used to be an important part of the mix, they peaked at around 15% of EM assets back in 2005, have shrunk now down to just about 2% of the overall EM asset space. So sector mix, you've got quite a lot of the kind of traditional sectors in the large cap space in Central Europe. So a lot of banks, a lot of oil refineries, telecom operators, utilities, and the like, as well as quite a few state-owned companies, particularly in Poland. And I'm not sure that the large cap stocks in the region are really capturing the GDP catch-up story effectively. Now, for the markets as a whole, there's a decent catch-up trade for the region. It has lagged quite a bit during the coronavirus period, and unlike the rest of EM, it has yet to rebound back to the first quarter 2020 levels. Now, Europe's recovery as a whole is a bit delayed given continued waves of coronavirus versus other parts of the world, but we expect it to come through in time, and that, in turn, should support Central Europe. We're also seeing quite a rotation globally from the tech trade into value, and as well as into economic sensitives like banking sectors. And these are all quite important sectors within the Central European region. Valuations are also supportive. In India now, an investor favorite, you're now paying 22 times 12-month forward earnings, or a 33% premium to the 10-year average. It's a similar story right across Asia, but for Central Europe, valuations are much, much lower, between 10 and 14 times forward earnings, and a premium to the 10-year average of between 1 and 13%. So valuations are not stretched by any means. And that's especially the case when you look against bond yields. And what we find is that dividend yields are now exceeding local bond yields right across the region, and are now well above bank deposit rates. Those low rates are generating a lot of retail interest right across emerging markets, but particularly we think it's likely to be a trend in Central Europe. We're seeing that in Poland. Retail is now 25% of turnover in Poland, and there are now 1.3 million brokerage accounts, with about 85,000 accounts opened in 2020. The other potential trigger is the index transition, if and when it comes. So Poland, Hungary, and Czechia are all emerging markets according to MSCI, which is the main index provider. Romania and Slovenia are both frontier. But one alternate index provider, FTSE Russell, has moved Poland up to developed markets and Romania up to emerging markets. But it's MSCI that really matters. And in terms of the potential changes we see there, Romania is probably the closest. It's got enough large companies to move into the emerging market index, but it's not quite liquid enough. Nearly there, but we don't expect an announcement this summer. That might be something for next year or the year after, once the liquidity has improved somewhat. For the transition from emerging markets to developed markets, well, Hungary and average for Poland, Hungary, and Czechia, something similar to the frontier average for Romania. So decent economic and earnings rebound story for 2021. What else could help? As Charlie suggested, a weak dollar would be great for the region if it happens. Central Europe is the standout, if you look at this graph, when it comes to market performance versus emerging markets when the dollar does head downwards. And also a weaker dollar tends to help sectors such as financials, energy, and real estate, all of which are pretty important in the Central European region. The final thing that will help when it comes is a rebound in the Eurozone economies once the final waves of coronavirus are behind us and we make further progress on vaccination. Exports are very important for Central Europe, and many of those exports go to the rest of the EU. So the rebound there, when it happens, we think will also be supportive for Central European equity markets. So to sum up, a decent economic growth and convergence story. It's been a bit undermined over the last few years by the strong dollar, and the size of the markets is pretty small, and that's not helping as GEM funds become more and more concentrated in their portfolios. You've had a few selected issues in the region related to Swiss franc mortgages, reversals of pension reforms and the like, which haven't helped. But looking forward, there's an opportunity now with the rotation that we're seeing towards value stocks and also the recovery in the Eurozone, which should come later in this year. If the dollar starts to weaken, that would be a big boost. We've got new pension rules coming in Poland, which could help depending on the take-up. And in the meantime, very low rates are causing a retail investor boom across emerging markets. And we're seeing something of that in Poland as we speak. Valuations are pretty cheap. Central Europe is under-owned by global emerging market funds. And you're seeing a recent pickup in the number of IPOs, particularly in Poland, in more modern industries, including gaming, which is attracting plenty of interest from emerging market funds. Over the long term, we have the index transition story. Not quite yet, but over the next few years, watch out for Romania going up into the EM index, and on a sort of 4 or 5 year view, potentially Poland going into the developed market index. With that, I will wrap up. Thank you very much for watching. The macro panel will start in 3 or 4 minutes, so please stay on this presentation on this channel, and the macro panel will start shortly. Thank you very much.
Ladies and gentlemen, thank you so much for joining this macro panel looking at Central Europe. This is Renaissance Capital's conference, and we're trying to get the equity investors, bond investors to be looking at Central Europe and seeing the opportunities available. I'm really delighted to have managed to collect a fantastic panel. Florin Chitu, Prime Minister of Romania, is going to be talking about what is for equity investors a really important frontier market. For under some indices, an emerging market already. It's well established, and I know the country very well for 25 years. I've been lucky enough to know Florin for well over 10 years. We also have Mateusz Szczurek. He was former finance minister of Poland, also a colleague that I've known for a great many years. Very handy with repairing bicycles if you ever have the misfortune to break down near him. And we've also got Wojtek Bender, who'll be with us in just a second or two. He's with the Czech Central Bank and is going to be giving us something of the central bank perspective on the region. If I can jump straight in, Florin, you've been Prime Minister now for, what, 3 months, basically?
100 days. 100 days, a couple of days ago, actually, 23rd, I think. The OSCE's priority is to deal with the pandemic as fast as possible. And we're having this vaccination campaign underway, and I'm actually putting a lot of resources into that to make sure that it goes well. Romania has been one of the countries in the top, 5, pretty much top 10 in Europe in terms of how well we're doing with the vaccination campaign. The only problem we had is the problem everyone has had with the supply of vaccines. But you know, I think this is the main priority. We also sent doses to Republic of Moldova, because in my view, you know, it is not enough for us to get vaccinated to deal with our problem, and then you know, if our neighbors are still having problems, then the pandemic remains. So this is the main priority right now, and it ties very well with the economics. Throughout last year, as a Ministry of Finance, I said that we should be able, after the initial lockdown, pretty much everywhere in Europe, once we got the stocks piles up and we got the, you know, piled up the masks and everything else, we got all the resources. I said that we should learn how to live with a pandemic, and we should keep the economy open. That was my goal throughout last year, and we managed to keep the economy open while fighting the pandemic. And it's just very important. Romania is not a rich country in terms of resources, you know, cash resources or, you know, reserves, you know, access to foreign markets. So it was important for me to have the economy open, to be able to pay current expenditures to fight the pandemic. And it worked out well last year for Romania. We ended up with the highest economic growth rate in December, in the actually fourth quarter among the EU countries. The end of year results are showing that the recession, the contraction was not as bad as anyone, you know, it was better than anyone expected. It was below 4%, so it's 2.9. We were looking to revisions that would take us below minus 2.7. So it worked out well. Now we're in the third wave of the pandemic. And, you know, we built the budget with the new coalition. And that's one thing that's very different for Romania. We have a coalition government that we're committed to stay for 4 years together. The main thing in the budget, the main resources are allocated to investment. We increased investment expenditures. We increased the amount by 8 billion RON, which is roughly 2 billion euros. And last year we had the best year in 30 years in terms of investment expenditures from the government side. This year we're increasing that amount, and you know, we want to make sure that that's get invested in the economy. The other novelty in the budget with those investments is that half of those money are related to EU funds. So this is something that Romania has been a laggard over the last few, you know, over the years. There's already been 2 exercises within EU. And then 2 budgets since Romania has joined. And last year was the first time we had 50% of these investments from EU funds. This year, again, we're hoping to do the same execution. So we focused, or you know, channeling resources towards investment. And we have not actually altered, you know, so we're not closing big businesses or anything like that, but we have not altered the fiscal code. We have not done anything like that. This is our promise, and this has been my promise in the campaign, that we're not going to increase taxes. We're not going to do anything like that to increase revenues. Yes, and this is, you know, it's been received well by the private sector, by the economy. It's been received with a question mark by the guys, you know, by those that analyze the Romanian economy, like rating agencies or European Commission. But every time I explain that to them, they get it. So we're saying, you know, listen, the main lesson from the crisis in 2008, 2009, 2010 was that, you know, you need resources to flow in the economy freely. You don't need to create, you know, to raise revenues, current revenues, by increasing current taxes. You don't want to give those permanent shocks to the economy. We're going to go on the other hand. So basically, you want to keep the fiscal policy to be stimulative on the short term. In the same time, to ease the concerns, we're starting, and we started this year, a major reform on the expenditure side. And it's been presented in the fiscal strategy. So basically, we capped all wages in the public sector. We stopped the increase in pensions that was promised by the previous government, which are not sustainable, and they all knew that. I'm starting reforming all state companies. So all these things we're starting this year. So in terms of wages in the public sector. We're redoing the law, and we're reassessing or realigning all the incentives in the public sector. So the idea is not to increase the envelope that we use around 11% of GDP last year to pay for wages. So we don't want to increase the envelope, but we want to do within that envelope, we want to make the reform. So basically, if you look at the trajectory for this expenditure, which was actually the biggest problem for our investors and for the people assessing us, we're saying, well, listen, over the years, the percentage of, over the next 4 years, the percentage of GDP allocated to wages or public wages is going to drop, but now we're not going to cut wages. We're just going to have a different dynamic. Nominal GDP is going to increase faster than this envelope, which I think is pretty much flat over the next few years. We have allocated enough resources there. We just need to reallocate it better inside. So this is the part of the big reform that we're doing is within wages reform. Yes, Charlie, I see you want to say something.
I'm just going to, well, there's 2 or 3 things that got raised. You inherited a terrible fiscal mess when you became finance minister.
Ministry of Finance, yeah.
The Europeans had decided that Romania needed to be dealt with under the excessive deficit procedure. That's been suspended now, I think, for all countries for a while. Do you know how long?
No, not for Romania. Not for Romania. The problem is that Romania was in the deficit procedure when everything started. So they suspended for getting other countries in. Because if it was not suspended, then everybody would be in. So they said, well, listen, you, Romania, unfortunately, were there before the crisis. So the procedure goes forward. So that's why this year I had to come with this lowering deficit for this year to be a credible lowering of the deficit, and also over the next 4 years.
And connected to that then was the issue of the rating agencies, which have, I think, got negative outlooks, and you're on the cusp of investment grade versus sub-investment grade. I don't think it matters a great deal if one of them was to cut a rating, but are you able to reassure them?
Yes, and that was last year I've been talking to rating agencies throughout the year, because the main concern last year was, are you going to increase pensions, expenditures by 40%, and I said no, and they believed me, and then we said until it actually was materialized, and we only increased by 12%, and then I said, throughout the end of the year there was also a threat that we might be downgraded. Because they didn't know what you're going to do next year with pensions, because there was an increase of 25% this year. And I always said, no, we're not going to do that. They trusted us, and we didn't do that. So basically, I do think that I have the trust of the rating agencies. And everything they've done has been transparent in terms of on the expenditure side. I mean, I'm aware of this unsustainability of both pension system and public wages, if the dynamic was going to continue the way that the socialists left it. So we're just overhauling that, and we're just doing, because the other problem, Charlie, besides the macro story, where you look at how much you spend on wages, for example, is the micro story, how those resources are allocated. And what I want to have in Romania is, to remunerate best those people that deserve in the public sector, not the ones that are better connected.
Sure.
So this is what we're trying to get to.
Totally get that.
And, the amounts are plentiful to pay those people well, and for those that don't deserve, if they don't like it, the private sector is there to actually, open arms, waiting for them.
I've got one question already from the audience, just saying, what's your view on the Sputnik 5 vaccine? But if you could answer that, and then perhaps move on to
Romania just uses only vaccines that have been approved by the European EMA. So that's, we're part of the EU, and we're using just only those vaccines.
Fair enough. And on the investment side, this issue of European funds coming in and starting to build out infrastructure is obviously one of the big advantages Central Europe's got over Turkey or North Africa, for that matter. When you talk about the government spending more on investments, what's the priority? What are you seeing? So that's one question, is where's that money going into? What are the major projects? And the second is, you talked about restructuring the state companies. That's been talked about so long in Romania. It's, you know, overdue. It's very overdue. What are the priorities? Do you think there's any chance of listing a few on the stock market at some point? Anyway, would that be a potential goal?
Yes. So let's take them one by one. So investments, obviously, Romania is no surprise to everyone, infrastructure and big infrastructure, and that's something that we're targeting funding from the new Resilience and Recovery Fund, EU fund. That's this is money that you can get fast and committed before 2022, 70% of it. So you have to actually move fast. So you can only use projects that have been they're mature projects. So that's something we're going to do. The other thing is developing the hospital infrastructure in Romania. I don't think there's been, in Romania actually is not, I don't think, for sure, the public has not built a hospital in the last 30 years in Romania. It's only, the only ones have been built by the private sector, they're in the private sector. But the Romanian state, although it's been pouring billions and billions of euros in the health industry, is mostly going for, wages and other things, but did not build a hospital. So my ambition is to this resilience plan to build few hospitals. There's three of them, the so-called regional hospitals. They've been financed by EIB, I think, and EBRD. They're going ahead, but I want to use these resources, the funds from the Resilience and Recovery Fund, to build hospitals in most of how many authorities we can do. I mean, I think if we can do 3, 4, 5 hospitals, is better than has been done in the last 30 years. So that's the other priority for infrastructure and investment. And the other one, it's actually on the environmental side, cleaning up the mess. There's been Romania has a lot of infringement from the EU on cleaning up on the environmental these holes or whatever, the way we treat our waste. And that's the other part of the investment. So those are the main priorities. In terms of the restructuring companies, well, I have to be pragmatic here, Charlie. Some of them will survive the restructuring, and obviously they will be listed. Some of them will not survive the restructuring, and either can be sold or they will disappear. There is one company, Hidroelectrica, that's is on the way, and that's going to go forward. I just passed a law. There's been I think it's in the Parliament and the Senate, has been approved, and is going to the Chamber of Deputies to cancel the law approved last year by the socialist government that stopped any selling of equities from state-owned companies for 2 years. So I'm canceling that, and then we're allowing investors to participate and capitalize these state-owned companies. I mean, I put it this way because there is a stigma in Romania, the socialist use, and throughout Eastern Europe, that, oh my God, you're selling our our treasures, and it's not that. It's actually capitalize them with foreign money, foreign tax money, in order to make them better, and they actually employ people, and instead of being the black holes that we have now that pour in government money, and then they just you never know what's happening with those money. So I think this is the story, and it's actually what's happening. It's not just a story. This is what's happening. We're using other taxpayers, people's money, to reform our companies to make them better. Some of them. I mean, I'm very pragmatic, and I've been telling that also to Romanian people that not all of them will survive. It's just it's a fact that we've been dragging 30 years companies that been loss making for 30 years. It's hard for me to see how they can. I mean, maybe there's some genius turnaround the guy somewhere out there that can take some of those companies and make them profitable. But I'm sure he's very expensive anyway, if that exists. But leaving jokes apart, I think that some of those things will not continue like that. So the reform has started already in few of companies, and I'm doing some other things. But obviously, my goal is to make sure that the If you are very careful with the money that you have from taxes, and if you use them carefully, you don't have to raise more taxes. So that's my goal, to show that actually the money you have and you invest them properly, and you have the reform, the public administration, you don't need to raise taxes to get more money. It's enough, and just leave more of those money for people to use.
Yes, I've got high hopes for what you're going to achieve. What's if I go back 10 years, I had a very easy sell story for Central Europe. If I go back to the 1990s, it was the convergence story. It was rising wealth levels. That's come through. The EU money's come in. EU membership has been achieved. For some of the countries, they've had the euro adoption as well. Looking from now ahead 10 years, and I'd like to draw in Mateusz and Wojtek as well on this. What's the vision of, where would you like Romania to be in 2030? What country should investors be thinking about? Because I'm comparing it a little to Taiwan, to Korea. It's an industrialized kind of zone, and at the moment, global emerging market investors, it's all about Asia, and I feel that Central Europe does offer an industrialized option for that Korea, Taiwan kind of thing. But what's your vision? Where do you want the country to be in 5-10 years? And I am going to come after you to Mateusz and also to Wojtek to see what they imagine too. But Florian first.
Well, obviously, I think it's time to grow up and go head to head with those competitors. I mean, we've been in the background for years, and we've been having this story that we need to still be protected a little bit. We need to grow. We need to investment. I think we're ready to open up and just go head-to-head international competitions for capital with those companies. We've seen that supply disruptions during the pandemic, the dependence on China and other countries, and I think that has opened up a lot of opportunities for a country like Romania, and open up a lot of eyes and minds looking at Romania as an opportunity. So in a nutshell, it's time to get ready and fight, be out there in the field, but with the big guys. Okay, not Germany or US yet or UK, but the other, the Asian countries that you mentioned, and countries in the region that have been doing better. We have no excuse anymore, really. And we've got the good labor force. We've been changing the legislation. We've been doing that in the next few months to make it, a bit more clear for everyone. We're under this administration, the property rights will be respected no matter what. Investors will be respected and will not be, chased down, et cetera, et cetera. So this is going to be, it's a new environment. So unless you're getting in the ring and fight for the capital, you're not getting a chance. Just playing on the outskirts, waiting, you have to be make yourself visible. And that's what the plan is for the next period.
Very good, and good luck. And Mateusz, what's your view? You're now at the EBRD. You were finance minister, I think, for 2 years, was it, in Poland? You know what it is to try and make change in a country, to try and make it perhaps more attractive to investors. What do you think Central Europe's selling point is now?
Well, I think the selling point of Poland is its ability to transform and adapt and readapt rather quickly to whatever is thrown at it, and that seems to be true even now, for good and bad, because if you have various restrictions related to COVID, then local entrepreneurs very quickly find ways around it, either through normal e-business routes or underground restaurant markets or whatever. So the end result is that the economic impact of various shocks time and time again turns out to be smaller than feared. That was true in the previous crisis. That seems to be true now. Now that makes life hell for someone who tries to manage the country. It makes it difficult to have a whatever tax policy execution requires more effort of various policies, and looking at where the country will be in 2030, your question. Well, on one side, Poland, because of its geographical position, is actually better placed than Taiwan or Korea because of geographical proximity. We do have a supply chain reshuffling benefiting already Central Europe, and at the same time, it's aging faster, which is bad news. I think we'll come back to this in a second. But on the other, it's able to attract, and so far it's been able to get more migrants surprisingly easily. But that said, there is one challenge that so far has been difficult, and that is the industrial innovation policy, which is a problem. I mean, it's easier to catch up if you are well embedded in the European world. It's easier to adopt existing technologies very quickly and build your success on this. To push the frontier, you might need a special interaction between the private sector and the public sector in terms of innovation policy, and that is where some countries do far better than others. And I think we're not quite there. We're not quite there yet. This will be the key to success.
Do you mean like tax?
Sorry?
Do you mean like tax breaks or?
Well, I mean, tax breaks are actually the easiest policy, which I don't particularly like in this respect, because if you introduce tax breaks for innovation spending, then everything is going to be booked as innovation, and it's the quickest way to improve your statistics, but not necessarily to actually push innovation forward. So that's no, it's actually more subtle than that. It's about the how you co-finance innovation, how you manage intellectual property, how you manage data. Instead of just giving it away to whoever manages to rule the particular segment globally, and instead build sort of local champions. So that's a challenge looking forward. And on visions, it's also I think it's ruthless. You asked me about my 2 years. I think that ruthless implementation is equally important than grand visions. I mean, grand visions are a joke if you're not able to actually implement them. And more often than not, real change is coming from the tiny things that you're able to do well. You may have a fantastic e-government system that nobody uses. You can have all the EU funds in the world available for cohesion and public investment, but you fail to do public procurement, environmental assessment. You worry about public official prosecution later on, and the whole thing is just stalls and nothing happens. More often than not, is the ability and capacity of the country to implement even tiny things, let alone visions. That's more important than grand plans.
You want to give me an example from your experience?
Well, I don't want to do before or after comparisons, being sort of politically involved still somewhat, but I think this is an important gain from Poland's EU membership. Why EU cohesion funds were so great in 2010s, for two reasons. One was that they came exactly in the right moment when there was a shortage of private demand, there was a global financial crisis, and suddenly there was money to be spent, and it was macroeconomically meaningful and needed. It didn't contribute to overheating of the economy like in Portugal 10 years before. But that was one thing. The second was that it allowed to upgrade state capacity to actually manage very large investment projects. You had to do it. You had to do it right for this money to clear. And not all countries in Europe managed to do it, and we did in Poland. So it's more than about the money. It's also about the people that were able to run these projects, and this is going to be useful even if you finance them in the market or through the budget, whatever. So that's absolutely crucial for any investment success, and also for this is what Florian is trying to achieve now after years of some disappointment.
Do you want to respond to that, Florian, or I can ask Wojtek?
Let's listen to Wojtek, because then I'll have just another intervention and then I'll go. So I want to hear Wojtek.
So Wojtek, on Czech Republic, do we have vision? Is Czech Republic another Germany in 10 years' time, or on a slightly smaller scale? But what are we looking forward to?
It's already cooler than Germany.
First of all, thank you very much for the invitation to this decent panel. And I'm very proud of my ex-colleagues who are generally more successful than me. So congratulations to you guys. And regarding the vision,
it's all relative, Wojtek. It's all relative.
Thank you, Florian. Actually, when from the vision of Martin Luther King, I had a dream. So my dream would be the Czechs would be in 10 years somewhere in like a Switzerland or Denmark. I think Denmark would fit well to the structure of the economy, to the cultural background and the population, and the sources. But of course, we have to be modest. We have to be cautious with the potential. So I think what's more likely is that the Czechs will be in 10 years close to Belgium. But of course, we currently don't have like a government parties or political parties that would have really strong vision where to head, because of course everybody's trying to solve the day-by-day issues and day-by-day agenda. But what really is important, I think, for the government, for the official institutions, is something like Isaiah in the Bible says, so make straight highways for the Lord to come. And so I think that should be the main task of the institutions. Like I am a policymaker in the Czech Central Bank, so we are independent central bank with our own national currency, and we have relatively broadly based portfolio. Unlike some other central banks, we also have responsibility for maintaining financial stability, not only price stability. We are responsible for resolution schemes for the banks, and and feels okay to invest here would have a good conditions. But of course, if you look like a data from World Economic Forum, when they try to assess the competitiveness of the countries, there are still some issues, or there are still some challenges for the Czechs. I think the level, structure, and quality of institutions, there's something that have to be improved. Infrastructure, business sophistication, technical readiness, and so on. Sometimes it's when we make the convergence reports and our analysis of alignment with the Eurozone, but of course we are not the Eurozone member, but we are tending to it, and we are heading there. Probably sometime in the future. So we are trying to assess how much we have. How aligned we are with the Eurozone as an economy, with this business cycle and so on. And sometimes Czechs are criticized to have relatively large share of industry, but on the other hand, it turns out to be advantage in special occasions like during the great financial crisis or during this COVID crisis, because that's the part of the economy that recovered always the quickest and supports the economic recovery, wage growth, employment, and of course it seems that it's a main driver of innovation and productivity growth. So I think that the main core of the Czech economy will remain industry, especially, and probably heading more forward to more sophisticated manufacturing, which in fact is associated with the car industry as well, because as we see, many innovation in industry now are concentrated in the car industry. Okay. You wanted to ask something, Charlie?
Well, and I was just curious about how COVID is showing up on the data for industry versus retail now. Is there a, I mean, I just wondering, because you're getting hit really hard right now. Czech Republic, I think, has some very high numbers. Is this, can you see it in the output? Is manufacturing holding up?
Manufacturing actually is holding the economy, at least because for some reasons there were no lockdowns in industrial plants. So industrial plants are working for 100%. But of course, we see, of course, some bottlenecks given the supply side shortages, like supply side of the spare parts for the car industry, which is not only the case of the Czechia, but also Slovakia, Germany, and so on. So we see it's a global, like nobody was prepared for this situation. And of course, probably not everybody was prepared for a relatively sharp recovery of the industry relatively soon. So these are the shortages. But of course, it's very difficult to judge the supply side on the retail sector because most of the retail sector is closed, and in the government, under government rules and decisions in order to prevent the pandemic spread. So this is very difficult to judge, but when we saw the previous figures, the industry right now probably is supposed to be main engine of the recovery in the second half of this year, or maybe already in the second quarter of this year.
I just wanted to also then turn this to looking at some of the challenges that have been addressed, and you've already touched on the environmental and car industry. I definitely want to come back to, but while we have Florin, because I know he won't be able to stay for the full hour, from each of your perspectives, I want to understand how you're thinking about this demographic issue. I was looking at some numbers the other day. East Asia's average age is going to be about 46 by 2050. This is China, Korea, Taiwan, and so on. Japan's around 46, 47 now. So we're basically saying all of East Asia is going to be where Japan is. We've all seen what's happened to Japan over the last 30 years with its aging society. And we're seeing quite a shift in the demographics in Central Europe too. I'm curious about a number of things here. Why hasn't this produced high inflation? Why have we managed to see high wage increases, and they have been really high over the last 5-10 years, and that not turn into inflation? Because if my haircut price has gone up, why isn't that showing up somehow in CPI? How does the government manage the fiscal side of this, either in terms of pressure, pensioners wanting more pension increases, and Florin talked about the previous government trying to push up massive rises, presumably to win votes, and then the shortage of tax revenues. There's less people working. I mean, the employment numbers are going up, and that's good for now, but how do you face the challenges on a 5 to 10 year view? Florin, are you still with us?
Yes, and Charlie, I have to say this is going to be my last intervention, and it's a good one that you raised, because they obviously, Romania does have a problem with sustainability of the pension system. It's something that's unique to Romania. In the 70s, there's been Ceausescu who had that ban on abortion, which had increased, number of birth. Well, those people, and I'm one of them in that generation, will retire in 15 years, presumably. And actually, if I look at the evolution of the demographic, that's when the system, I mean, the people that will work then, the population, the working population then will not be able, the resource will not be able to pay for that massive shock to the pension system. So obviously, we're starting this year a reform of the pension system, which includes, it's something that's out there these days. We're allowing people to extend, because we've seen that more and more people wanted to work beyond the retirement age, and also we're working on the other end, creating and I've seen some studies done in Harvard, which basically you're looking, is it better to increase the child allowance, or is it better to create a child care system that works? And obviously the second, although the populists will go for the first example, increasing child allowance, actually the one that works over the long term is creating a very good childcare system where people can leave their kids safely, and Romanians that live in Romania not to live and just be happy with their environment, economic environment and social environment. But I think over the short term, if you're not allowing more immigrants to come in the labor force, you might have a problem over the short term. We've seen that throughout Europe, and I mean that's the direction we're going. And we're looking now at the shortages of doctors, for example. And to me, it's amazing that the law in Romania says that you have to be a Romanian citizen to be a Romanian doctor, but UK and other countries are solving their problems with Romanian doctors and other doctors from Pakistan and India. So it's ludicrous and stupid. So this is something that I'm working on, especially right now with the shortages of doctors. The labor force, I've been looking throughout, over the last few years into what's happening in Romania, and Romania did have an inflation scare before 2019. I mean, the spending, overspending, and fiscal policy stimulating beyond potential. We've seen, inflation bubbling. And Romania was the highest rate of inflation, reaching even 5% before the pandemic. But as I look at it, there's something to be said for that A factor from the formula, for the productivity, the unmeasurable factor. I mean, I think short term, and I talk about 3, 4, 5 years. I think does explain not having the pressure from the labor force pushing immediately into inflation. But I think over the longer term, if we were to do the same mistake and push the economy using fiscal policy when the economy is going above potential, you will see inflation in Romania. I mean, the Romanian economy is still not as evolved as others, so those things still work over short term. But we're not going to do that. So we're not going to push things beyond the potential with fiscal policy. Although I think right now, this year, and fiscal policy will remain stimulative for this year, and then we'll withdraw the fiscal stimulus shortly from slowly from the economy. But it is this is a very good challenge for economists. I mean, I don't have that much time anymore to work and do research. I hope people at the central bank or other people like Mateusz maybe have more time and give us some results. But it is a question for our region. We've lost labor force. It went to England, Germany, France, Spain. Some of it has returned, but if we really want to, think about 20 years in the future, we need to have a plan, to increase labor force. It's not just about productivity; it's also increase the labor force. And as I said, the solution for Germany, France, Spain, Sweden, Denmark, UK, US has been immigration. I don't think we have another solution. Honestly, I mean, you can scratch your head and try and do something else, but unless you're allowing other people to come in, I think you're pretty much out of options. Unless there's going to be a massive technology shock, we've been waiting for the flying cars for some time, and I don't think that they're here very soon. So the massive technology shock right now is we've seen improvements. But we're not there. We're not in the flying cars environment. So still labor force for the next decades.
Florian, thank you so much for joining the panel and for giving us input. It's been really, really fun to see you again, and I hope to see you in person in a few months' time. So good luck with everything, and we hope to be getting investors paying more and more attention to Romania.
Well, yes, it is. They should pay more attention to Romania. It is. It's coming up, and you'll see great things from Romania in the next period. Thank you, guys. It was great seeing you all again. Stay healthy, and we'll see you guys next time.
Well, good luck, Prime Minister.
Thank you. Thank you.
Mateusz, could I jump over to you? You're in Poland. You actually had a government reverse the increase in the pension age. I think it was going to go to 67, right? They brought it back to 65. We've also seen in Poland, and even more so in Hungary, the private sector pension funds that were there to deal with this demographic change get taken back under kind of the government's wing. You've seen this massive shift of Ukrainians coming.
Was above the median income of a Polish family. And still, in times of deflation, we had to sort of explain ourselves as government why indexation of minimum pension is so low. Well, because prices went down. That's the mechanism that we adopted. So this pressure is going to be higher and higher. We see this last year with the 13th and 14th pension being proposed, and it's going to get worse. So all the pay defined contribution systems will be cracking. They're already cracking, but they'll be cracking more. Why it was so terrible for the for the pension age to be reversed. It's actually not from 67 to 65. It's also from 67 to 60 for women, which is actually quite a change. Of course, you know, in practice, we will be working longer. There's no doubt about it. But politically, I see more trouble ahead. That's for sure, because it's going to be very difficult to resist increases in pensions and overall net benefits of pensioners compared to everyone else, because they will be so numerous and so powerful politically. We see this in the UK too.
I was just looking at the numbers. I mean, because I got 15%, well, 14% perhaps because of COVID, but still 14% rise in the number of pensioners just in the next 5 years in Poland. That's a hell of a increase in the voting public who are going to be supportive of those sort of measures.
Well, it's actually even more, the dynamics is even more complicated because of COVID, because we just had literally, I think today or last couple of days, we had the latest official life expectancy numbers. And they, for a 60-year-old, they went down only last year, by 13.6 months. And that has a direct translation to the pension calculated if you happen to retire this year. It's going to be 5% higher. It's actually quite a change that might dissipate over the years, but we'll see. So I mean, of course, the pension systems will be a challenge. Now, Poland is slightly different compared to say Slovakia, for example, because everyone is aging. But despite of the rhetoric, despite of what you might have been reading in FT, Poland was in the last couple of years among these two countries having their own demographic problems, of course, and so making the situation worse there. But this proved a major stabilizer for the labor market. Also in COVID, because of physical restrictions, unemployment fluctuations were limited because the short-term labor and people from our eastern neighbors could not come in. But this is not the end, and that's something that we want. I mean, this is the way a country graduates towards higher value added. Along the higher value-added ladder. So you want the sectors that are based on cheap labor to wither and die. I mean, that's the way you graduate to a developed market status.
Wither and go to Egypt and North Africa as well.
Oh yeah, of course, within the country, of course. Yeah. And it's a terrible story if you happen to have a firm that is in the sector, because you just cannot compete with Egypt. But at the same time, for the people actually that live in Poland, that's great news, because you have other opportunities of the firms that are able to pay you more. So if the average wage is going up, that means that someone is able to pay. The only challenge is if this process is too quick, too rapid. You have to have, destruction not overtakes as a challenge for the entire EU. I mean, from Africa, from poorer countries, Europe will be sucking in people and welcoming people. But the trick is how to ensure a balance of good job matching, so the doctors will find their jobs as doctors, but at the same time to manage the social and political pressure from a shift from a very homogeneous countries, which Central European countries are, especially Poland, Czech Republic, Slovakia, less so Romania maybe, to a much more diverse economy, and that is politically tricky. A method to do it is to rely on short-term labor, require people to leave and go back and so forth, to deny them a proper citizenship. But that makes it difficult to employ doctors as doctors. Yeah.
Brilliant. I totally agree, and we've seen the challenge of that in Japan as well, which is me trying to seek into coming back to Wojciech on this. Mateusz, I'm going to come back in a minute on the environment. We've only got 5 minutes left of the session, so I'll try and be quick. And Wojciech, if you could try and address two issues. One is maybe inflation is not going to bark like it didn't really do so in Japan as they became an aging society. Is that a perspective you look at from the Czech Central Bank position? And secondly, is there anything on the environment side, the ESG side, that's relevant to Czech? And then I'll come back to Mateusz perhaps for a last word just before we wrap up in 5 minutes. Wojciech, to you first.
Oh, Charlie, thank you for your good question. Actually, it's very good to follow the economic discussion during the past 3 decades, like starting from the new economies of the Central Europe, I would say. Maybe one of the reasons is the convergence story. So there is some potential for faster growth of prices just in order to catch up with the higher levels in the more developed countries like Germany, Austria, and elsewhere. The second reason, the reasons are probably independent monetary policies that the banks can really adapt to accommodate the policy to the needs of the economies in order to maintain a relatively stable inflation. And the third reason is probably the convergence more via interest exchange rate appreciation in long term than via the inflation differentials. And that's one of the reasons, of course, why the Czechs are really reluctant to join the Eurozone, because they don't suffer from nothing that would be the cure Euro for. So there is a low inflation, there has been a relatively low inflation, there have been always relatively low interest rates, not only for the corporates, but for the public as well. And also the people who are benefiting from gradual appreciation of the currency that are pushing them to the higher levels compared to the Germany, for example. And I think this is the pace we will follow also in this decade too. So we will converge not to the higher levels in prices, not via the higher domestic inflation, but via convergence via exchange rate. And I am not feared that much from the higher inflation, because still I should not, because I am responsible for maintaining the price stability. So if I would say I'm fearing inflation, people would say, what the hell are you doing there? So this is the task for the central bankers, and the invention, of course, now is a discussion about the heterogeneity of the impact of monetary policy. So whether to use the broad instruments for the whole economy in order to maintain inflation contained, or whether to focus to separate sectors or quantiles of population with different incomes and so on. That's the discussion that will be probably more intensive during the next 10 years. I face the same problem as here, as Mateusz mentioned. So the aging, the pension schemes, the non-existence of the solution of the pension schemes, and the problem with immigration, because for those countries, we still have some positive increase of population, but mainly because of the immigration. And the immigration comes mainly from the countries the culture is similar, like Ukraine, Poland, Slovakia, which in fact you only forward the problem to the other countries, but you don't solve the global issue. And this is something probably that will not be solved by the inflow of immigrants from Africa because of the language barriers, cultural barriers, and the fact that those people usually want really to head to more developed countries like Germany. They don't want to stay in Central Europe because it's still relatively poor compared to the other opportunities. So I don't think the inflation is an issue. I think that the reflation story, which is quite popular during the past couple of weeks, I would say not months, but the past couple of weeks, is only temporary. And of course, the main issue now is we saw some increase of inflation during the last year. How much is demand pulled, or how much is originated in the supply side shortages? This is the main issue, and I think that's 65% supply side originated and much less in demand. So this will probably one thing that will be very important to discuss, but inflation issue is not, I personally don't think inflation will be issue for the next 10 years. And I still think that the Czechs and Polish and Hungarians are able to converge to the more developed countries via through the exchange rate channel.
We're literally at time, but I'd love to just get 30 seconds, 60 seconds on the environment, because I've got a teenage daughter who cares a great deal about this, as do I, obviously. But what's the biggest environmental issue for the Czech economy? Just 30 seconds, 60 seconds if you can.
Okay, that's the energy mix, because we are currently with the renewable sources at the level of average in the EU, and there is not much scope given the geographical conditions to increase it further. So the next issue is whenever we want to build sustainable sources, whether they continue with the increase of share of nuclear power plants, and discussion inside the EU whether this is acceptable contribution to the energy mix in order to remove and replace the coal burning on oil and all the fuels, this fossil fuels. And the problem of this energy, of course, the return of investment. It's very long term. It's not 10 years, but it's like 60 years. And the guarantee of prices and the future development of prices. And that's the main discussion between the investors and the government. And of course, they play a role, the political, geographical interest, whether to join to China or Russians could join the tenders or not, whether they're acceptable, whether the technology matters or whether politics matters. And this is the main issue now when it comes to energy mix.
About just one, I got to ask this by a client yesterday when I mentioned this call, and they said, "What about the car industry? It's it's all petrol engines, it's all diesel engines. What are you going to be able to manage that transition? The Czech Republic is such an important car producer."
Actually, the Czech car industry already transforms into more production of electric or hybrid cars and so on, but of course it's not very much for the domestic demand, because the problem associated with this technological shift is increase in prices of cars. So mostly this is oriented to export. And the second problem is also for from the domestic side, the infrastructure, because I have my electric car for my wife as well, because it's cheaper and you can park in the blue zones in the city. But you have very limited places where you can, not because I will be so environmentally oriented, but it's very practical. And but it's very difficult to find the places where you can charge the car. This is something, the problem with the electric infrastructure, with the charging, and with also legislation and the government support, whether they really want to support this or not. But given the fact that the car producers in Czech are a part of global players, so in fact they are very much involved in the development and the technological changes and investment and improvement, so on. So they produce the car for the exports to China, to Poland, to Germany, Switzerland. So in fact, it doesn't very much matter how environmentally friendly is the domestic environment, because they find the market. But the problem generally of the car industry, because every year I open the conference of Association of Car Producers in Czech, is the tradition, and here and with my speech, and always I hear the problem is that the personal innovation potential in the companies in order to achieve the competitiveness is gradually replaced by the government or an official institution like European Commission regulation, who gives you, in fact, the targets for the emission. In fact, they really much control the development of the industry. So you are much more in the trap of regulator than you were 15 years ago. And that's the problem. In fact, it's very hard, that gives you very much of uncertainty of regulator. What will be the intention of the European Commission in next 15, 20 years in order which levels of decrease of levels of CO2 emissions you want to achieve or not. And I think this is something that really not brings the boost for the technological innovation. It
has got this brown coal issue. You were talking to me about pollution just the other day. What's the story? But again, we do have a minute or two, but this would probably wrap up the conversation. So,
if you want the biggest environmental challenge, that's air quality, hands down. I mean, it's crucial from local health point of view, and it's quite tricky to solve politically. And that comes not so much from brown coal, but it comes from household heating installations. If you look at the challenge of environmental transition overall, I think I'm actually far more optimistic than that. Poland is the biggest exporter of electric car batteries in Europe, pumping 400 million euros a month already. And that's 2% of exports. And that's before the further 5 times expansion comes online, which will put Poland in the first place in the world, supplying 60% of batteries in the EU. There is more. I mean, if you look at wind capacity, it's 6.6 megawatts, which is at par with the Netherlands, higher than Denmark or Austria. Of course, not per capita, not yet. But the offshore market is only coming, so starting now. So again, it's the same reinvention story. Give the regulatory environment, be it local or the EU one, and enforce it, because this is the real trick, and you will have a really quick adaptation to this environment, and we're already seeing this. And there's probably more to come. I mean, smart grid IT solutions catering for distributed power generation, wind turbine recycling, or production. I mean, Poland is a powerhouse in composite hull yacht industry, and is actually not that far different from producing turbine wings. So we will have that coming. Adopting to the environmental environment. I think most important is actually for air quality, which I mentioned, is actually enforcing it, and shielding the people poorer and sort of not rich enough today to finance cleaner sources of heating and energy.
Unmuting myself. Thank you for that. That was I had no idea that Poland was doing such a big job on that battery side, nor indeed that there'd been that shift to wind in that way. So thank you very much for that. Both of you, I think I'm going to wrap it up here. Thank you so much for joining. I really appreciate your time. It was really fantastic to get your different perspectives, and hopefully this has been useful to our audience as well. Very much looking forward to seeing you guys for a drink at a bar sometime soon.
Thank you very much, Charlie. Have a good day.
Pleasure. Take care, Wojtek.
Thank you.
Bye, Mateusz.